Meet Kevin produced a pretty interesting video yesterday that I thought, let's go ahead and react to this here today on the reaction channel. It's a perfect video to react to. There's basically this, it's starting to brew out there a little bit. I've seen it on X, otherwise known as Twitter. Some people talking about we're going to have a potential market crash, correction, whatever you want to call it, here in March, okay? And there's reasons why people believe there's going to be this correction crash in March. And so I thought I'd go ahead and react to Kevin's video, which addresses this here today. He talked about many points, kind of stocks he thinks are good short opportunities in the market and those sorts of things. So I thought this would be an interesting video to react to here today on the reaction channel. I appreciate everybody joining me as always. All I ask in return, smash that like button and make sure to subscribe to the channel. We got a little baby channel here with 40,000 subscribers, and I appreciate each and every one of you for being here. New all-time high subscribers. I appreciate all of you, okay? So let's go ahead and get into this. By the way, if you want to follow me on X, go ahead and check out pinned comment down there, or Instagram. I'm pretty active on both. X more active though, and that is pinned comment down there. All right, guys, let's get into this.
In this video, we are going to talk about the Great Crash to start March 11th through March 15th. It's now law. Yes, we are going to respond to a YouTube video where basically somebody spends 13 minutes telling you that because the Bank Term Funding Program is coming to an expiration on March 11th, we're all screwed, and that's exactly why billionaires like Mark Zuckerberg, Jeff Bezos, and others are selling, and people like Warren Buffett just this weekend suggesting that opportunities to outperform are very low right now, so he continues to sit on record high levels of cash. Is this possible?
So a couple things there right off the bat, okay? So, you know, the people that are trying to point at Bezos selling or Zuckerberg selling, keep in mind those guys are pretty much consistently selling, especially Zuckerberg, like year in and year out. Then if you want to go ahead and talk about, let's say, Buffett holding a lot of cash, well, Buffett's been holding a lot of cash for many, many years at this point in time. I mean, heck, almost a decade now, they've been holding ridiculously high numbers of cash.
Because the billionaires know. Yes. Is it likely because of the Bank Term Funding Program? No. In this video, we're going to describe where the real bubble problems are, and I'm going to show you some examples, some of which you might actually even be able to make money on as the crash does occur, which eventually it will. Let's talk about it in this video. First, let's talk about the Bank Term Funding Program. Yes, the Bank Term Funding Program is a bank lending facility that comes to an end March 11th. Most people don't understand that when that program comes to an end, it does not mean all of the $164 billion that have been lent come due. That is not true. Only about a third come due within the first quarter after the Bank Term Funding Program ends. And it really takes an entire year for that Bank Term Funding Program money to come due for banks. One of the places that you can, in my opinion, really watch for that sort of regional stress of how much do we actually think the end of this program is going to affect banks is twofold. Number one, you should look at a bank like New York Community Bank, who took massive write-downs, allowance for credit losses of almost $500 million because of just two buildings in real estate, office, commercial-related buildings. Just two properties wrote them down $500 million that destroyed their earnings and their potential for cash flow so heavily that the stock plummeted. Now, in the weeks afterwards, the company said, but don't worry, we are not having a bank run, we're not having outflows. That's probably because, frankly, the U.S. government has sort of insured all deposits in infinity. Sure, we're supposed to be insured up to $250,000 for depositors of bank account cash. But the reality is the FDIC insurance limits after the Silicon Valley bust and the essential full-on bailout of the banking system is realistically way higher. So you're not really seeing banking runs exacerbate these issues. As a result, I actually don't think the next crash is a banking-driven crash. That was last year's crash. So what is the crash? Well, I'll give you two crashes coming up, and these are very important to pay attention to. But I just want to finish the point. This is the Bank Term Funding Program. Notice how drawdowns on the Bank Term Funding Program have actually flattened out. Now, yes, they did rise here. That's because there was a unique arbitrage opportunity. Forget the science behind this. Basically, you were able to borrow money from this program for less than you were able to lend it out for. That was kooky. The Fed stopped that. As soon as the Fed stopped that, you got one last little push here of borrowing, and then you had a drop.
So let's use a little common sense here for a moment. I think common sense is always prevails in many of these situations, right? People predicting some sort of epic market crash that would come at the hands of the government, right? That would come at the hands of the Federal Reserve. Do you think they would let that happen? Do you think they would let themselves crash the market going into an election, right? Like, you know, I mean, it's a potential, but is that a very high probability? You got to think about these things sometimes, right? And when you're talking about a full-blown crash that potentially takes down the economy, because that's what you're talking about when you talk about crash, a little correction, a little 3, 5, 7% correction, who cares? That's eating Girl Scout cookies. But if we're talking about an actual crash, you think the Fed's going to let that happen on their watch and J-Pow and those folks? Okay, that's just, I think I'll take the other side of that bet.
Flattening, we should call this. I don't really call that much of a drop. It's more of a flattening. This is a problem, but I don't think this $164 billion here is so systemically problematic. And we're not seeing signs that there's this rush towards March 11th. We're 2 weeks-ish away from March 11th now. There's not this insane rush of people piling into this facility going, that's it, last chance to get cheap money. There are other ways for banks to get funding, whether it's from the bond market or from the stock market, or quite frankly, it's from the Fed's discount window. You don't need the Bank Term Funding Program for everything. Okay, so let's put that aside for a moment. Let's instead
well put. Next up here, let's address something, because some people are always thinking about, okay, this potential crash or corrections coming here in March. I'm going to wait till then to buy. At the end of the day, guys, it might come, it might not come. You might be paying significantly higher prices for stocks 2-3 weeks from now than you're paying today. At the end of the day, you see great deals out there. You got to take advantage of those deals. Don't worry about trying to buy it at the perfect price. I'm buying this coming Friday. I'm buying the following Friday. I'm buying the following Friday. This whole it's gonna crash 2 weeks from now. That's what I'm going in. It's a silly game, guys.
About the other two crashes, and they're in two totally different markets. One has to do with stocks and AI, and the other has to do, quite frankly, with real estate. Let's talk about both of those. So where am I seeing bubbles right now? Well, one of the largest bubbles that I'm seeing right now is ARM. Look, I understand the company's got phenomenal margins selling their infrastructure code bases, and I know I'm going to get a bunch of tech comments on describing what ARM is. It doesn't really matter, their risk architecture. We don't have to get into that. What matters is that this is a company that is trading for over a 4 to 5 PEG with one entity owning over 90% of the shares of this company, and the lockup for this company is set for March 12th, the lockup expiration. That means this is a company that IPO'd. And after you IPO, what you do is you have companies that say, hey, you know what? Investors, internal investors say, we will promise not to sell until 180 days after a certain date. Well, that date is right around IPO time, which was in September. So we're looking at March 12th. I believe it's highly likely that this stock will see a very rapid decline, possibly leading into the lockup. And you've got multiple catalysts here. I think you've got a negative catalyst going into the lockup, so leading up to March 12th. So I think you can see a decline before March 12th as traders start pricing it in. I think you could see a further decline during the period after the lockup if SoftBank actually starts selling, which I expect them to, especially if these valuations hold. Or you've got another.
So is Kevin correct in regards to ARM potentially falling quite considerably? I'll say this. I'll say he's probably right. With that being said, it's not necessarily something I want to make a move on. I don't know the company in depth enough to really have the conviction to say, okay, I'm going to go ahead and buy put options on this one. And also, if I had to guess, I bet you the premiums you have to pay on those put options is going to be very high. Why? Well, do you think Kevin's the only one that realizes, this lockup's coming? No. Obviously, everybody in the market knows this. This is a huge market cap company, right? So I bet you the premiums you have to pay, a few weeks from now, if you want to buy put options, is going to be very high premiums, very high premiums. So then you need the stock to really have quite an epic crash for those premiums to go ahead and print money at that point in time, right? And so just a little food for thought in regards to that.
Catalyst of March 20th, which is the Fed's release of the summary of economic projections. I think all three of these are going to put a lid on this growth and B, lead to substantial downside. I will say, though, in full transparency, I am short this sucker, okay? So I'm kind of betting that this one falls. However,
short, that's a whole different situation than buying puts, right? It's a dangerous game to play. I'd much rather just play it from the put side. But with that being said, I do think there's a high probability the stock does come tumbling down in a major way. But here's the problem. Here's the big problem, okay? Getting the timing right is extremely difficult. There's a high probability, I think ARM falls 20-30%. But the question is, when does that 20-30% correction, crash, whatever you want to call it, come for the stock? Is it next month? Is it the month after? Is it the month after? It's a high probability it happens at some point here. But to get the timing right, and who's to say the stock doesn't hit 200 plus before that crash comes. That's the other hard part, is getting that timing right, man. It's absolutely a vicious game. It's very difficult to be a short seller. That's why I prefer, personally, I hedge my portfolios, and that's about all it is in regards to that, because the rest of the game is tough. I mean, just ask the people that have been betting against NVIDIA, for the past year, when it went to 150, they're like, this is ridiculous. And then it went to 250. Oh, no, 350, 450, 550, 650, 750. Stock's on its way to 1,000, and they're still trying to bet against it. And it's like, whoo, it's a tough
that
game.
I'm not short on that I think are also stupidly valued right now. Look at Wingstop. Wingstop's been going straight up. This is trading for an over 4 peg price to earnings growth measure, which is an absolutely insane valuation metric.
I'm 100% on Kevin's bandwagon here with the Wingstop. Yeah, valuation's out of control. There's another one that it will come crashing down, but once again, getting that timing right is difficult. So
the same is true for Costco. The problem is the market can remain irrational longer than you can remain solvent. And just as much as I think ARM is going to collapse, I think Wingstop is going to collapse. And my real question is, what companies are going to go down with these companies when they actually start crashing?
Costco is a tough one to bet against. And the reason being is Costco always trades rich. It always trades at a big premium versus Target, Walmart, any of those sorts of companies. Their peers, if you want to call them that. And so that's a tough one to bet against. And also they have huge international opportunity in front of themselves. Plus the United States market is just a beast for them. So Costco, very high valuation, but you really can't bet against it because it's flipping flapjack in Costco.
Are we going to see an allocation? And this might be the copium idea. Some people are really hopeful that when those start crashing, people will allocate to other stocks that have performed poorly, which could be, as an example, Tesla. It's up almost 4% today. That's great. But it's just him and Han around the 200s. Who cares? That might be more copium to think that there'll be a crash in some sectors and a movement over here. Some people also think that the Magnificent Six, really, everything minus Tesla, will sort of have a little breather and pause, and there won't be any kind of real downside correction. We'll see. But that's just one of the places that I'm seeing real risk. So I'm not going to babble to you for 14 minutes about, oh my gosh, March 11th, mark your calendar for March 11th, or, and all of a sudden the bank term funding, it'll probably end. In my opinion, nothing will happen. If anything happens, just recognize the Fed will just open up the facility again. They never said they can't reopen the facility.
100%.
They're just going to bail that out again. And don't get me wrong, it's all rigged. Yeah, I think there are problems.
Kevin's 100% right on that. Now, before we go further here, he spoke about rotation of money, right? Let's say money comes out of certain stocks, and he was talking about maybe it goes into Tesla or things like that. Where I could see a potential rotation, if you're going to see some rotation out of some of these other stocks, right, some selling activity, where I could see rotation happening is actually in some of the small caps, right? We know there's been a lot of people predicting small caps are going to go on this big run this year. You know Tom Lee's prediction of small caps running 50 to 60% this year he's talked about, right? And so we're already about to go into March, and small caps haven't moved that much yet, to be quite honest, so far this year. And some smalls have actually gone down. So if we're going to get this big run, we got to get it going here pretty soon. And if we're going to get that run, then, it's going to come from, I can tell you, definitely some rotation money. And when money rotates from some of those big dogs into some of these small guys, the moves can be pretty darn dramatic. I mean, today's a pretty dramatic day. Look at some of these smalls. Avant's 12%, SoFi 6%, Palantir's not really a small. I don't want to put them in that category. Fubo 3% plus, Revolve about 2.5%, and that's off a Russell move there of 1%. So, it's like if that Russell gets moving, my gosh, some of those smalls are just going to fly.
Consider the inverted yield curve. We're now negative 44 basis points inverted. It is worsening. We were talking about that at ehack.com this morning, where we're talking about how the inverted yield curve is worse than where it was most of the beginning of the year. We were like 20 to 30 basis points inverted. But the problem is, you don't have the recession yet. You look at Bank of America's fund manager survey. You've got 41% of fund managers think there won't be a recession in the next 12 months. 21% of those who do think it'll be next quarter. And another 20% think it'll be the next quarter thereafter. So in other words, in the next 7 months, you've got about 40% of fund managers who think we'll be in a recession. The problem is we've essentially printed our way out of a recession for now. We've probably just kicked the can down the road. That's probably why we have an inverted yield curve. We might be in a recession in 25, 26. Think about it. The AI bubble growth slows. You don't get that growth contribution anymore. The fiscal spending goes away from a Biden administration throwing money at the CHIPS Act and Inflation Reduction Act, potentially, over $1.3 trillion per Goldman Sachs estimates because of loose Treasury interpretations of the rules. Basically, massive corporate welfare and stimulus going to the richest, right? It is rigged. I'm not making this video going, no, that person's wrong. It's not all rigged. No, I agree. It's rigged. I just don't think the bank term funding program is what you got to pay attention to. These valuations are you pay attention to. You pay attention to the fact that the 2-year Treasury is 4.7 and the 10's like 4.6, 4.26. So that's an inverted yield curve that's worsening. You pay attention to the spike of inflation we had in January, which even if that spike is transitory, that's a nasty word to use, but I think January was heavily exposed to seasonal inflationary impetuses. I'm not horribly worried about that as a catalyst. I am horribly worried about the next bubble, and that is multifamily real estate. Now, you have to be really careful in this one, okay? So just type into Google. Do it with me. Mortgage, delinquency, multifamily. So Wall Street Journal, mortgage, delinquency, multifamily.
Okay, before we start talking about delinquencies and those sorts of things and all that, let me address one point. Because you were speaking about recession, not being here and whatnot. I go back to, I think there's one core reason we haven't seen the recession show up yet and unemployment jump significantly. In my personal opinion on this, it comes down to construction. Construction, if you look back at the great financial crisis when construction jobs went away, unemployment skyrocketed, right? And the problem is, or it's a good problem to have, home building is still insanely strong. Look at all the home builder numbers. They're shockingly strong. In a horrible real estate market where inventory is not moving, it's benefiting the home builders in a massive way because people are not wanting to move off of their 3%, 2%, 4% mortgages. So they're staying put. So then for the people that actually want to buy a house, they're basically forced to go buy a new home if they want something, decent. And so they go buy a new home. It creates a massive amount of construction jobs, right? And the indirect and direct jobs from just one house being built it's unbelievable. And so you have that. Obviously, Kevin was speaking about the CHIPS Act there and those sorts of things. I mean, go out to Arizona and drive around and check out TSMC facility. That facility is away from one of my rental properties, probably 10 minutes away. Oh my gosh. Like you see this facility and you're like, holy smokes. And you see just the ridiculous lineup of cars out there of construction workers working on that project. It's like, I don't want to say it's like something you've never seen before, but it's pretty insane to see. And then check out Intel's operations that they're building out, which is more on the east side of the valley. I mean, when you look at these and the direct and indirect jobs that are benefiting from this, it's insane. And so until we can get the new home building market to fall apart, and then obviously all these chip buildings being built and all these sorts of things, until you get that to kind of break down, it's tough. It's going to be really tough to break that unemployment rate, which is good if you're bullish on the economy, right? But at some point that will break. New home building will break, but to predict when that's going to happen, you could be talking 2, 3, 4 years still. Because the thing is, you look at these home builder numbers, they're still incredibly strong. Home builders take anywhere from 9 months to 18 months to build a home. So I would say unemployment rate, I don't want to say is guaranteed to be low, but it's a high probability the unemployment rate is low for at least the next 12 months. And then the stronger and stronger backlogs the home builders have, the more and more likely that kind of pushes things out here. And that creates, a tough dilemma. If you're short the market or you're a bear and you're waiting on this unemployment spike, that's a tough game to play, man.
This is what it looks like. You just go to the first click right here. And this article is what you should be concerned about. The gist of it basically is that you had 0.9% of multifamily apartment buildings that were delinquent. 0.4%. Let me make sure I have that right. 0.4%. Yeah, there it is. As of January 2023, 0.4% of some of these collateralized loan obligations were delinquent 30 days or more. That was up 20x in January of this year. And you're seeing this not just at Arbor, but across the board. You're seeing delinquencies across the country in multifamily real estate, specifically in the Sunbelt area, explode. There are multifamily-based companies that all they do is multifamily and sun-based, and they're selling for a fraction of potentially what they're worth. Why? Because of oversupply of new construction, rents coming down, and loans coming due. There are a lot of multifamily home builders, that includes developers, and owners that have loans coming due. They don't have the benefit of the 30-year fixed rate mortgage. Now, does that mean?
So right here, what Kevin's talking about is definitely a very good point. I like this point a lot. And, I can tell you out here in Vegas, I mean, the amount of apartments being built over the past few years is substantial. Same thing when I go out to Phoenix, Arizona. I mean, it's just like everywhere you drive over that valley, it is just apartments going up. But the main reason, like why are all those apartments being built? Well, a lot of them were funded off of much cheaper interest rates when they were started, right? The interest rate environment was different then. And then on top of that, you have the Californians movement, right? Everybody knows that. Californians, where are Californians moving? They move to Vegas, they move to Phoenix, and they move out to Texas. Like they move a few other places as well, but those are the three, if you think off the top of your head: Vegas, Phoenix, Texas, right? Austin, Texas, Houston, Texas, Dallas, Texas, the Fort Worth area.
Housing is going to come down, single-family homes and condos? Maybe not, because of the benefit of the lock-in of the 30-year mortgage. But multifamily is seeing massive opportunities. Mismanaged buildings and loans coming due create opportunities for companies to go buy. That's what we're doing with House Hack. Well, we may have gotten lucky with timing because we really started buying in Q3 of last year, and we see the problems worsening while valuations on single family have been stable or up, which that's what we started buying. Now here in the spring, we're like, okay, shortage of single family has gotten worse. Most single family hits April, May, so let's wait again to buy in single family until April, May. Where's the biggest pain right now? Multifamily. So where are real bubbles coming in March? It's not the Bank Term Funding Program. That's fugazi. That's nonsense. It's probably not an unemployment recession either at this point. I think, when we look at layoffs as...
By the way, I don't think Kevin's timing was the best with starting House Hack. I think he should have, my personal opinion, he should have waited until the next unemployment-related recession and then start House Hack right after, you kind of are bottoming out that unemployment recession. I think that would have been the perfect time to start that. I don't think, the real estate market we're in right now or have been in, I don't think it's the best time to start a real estate project like that, in my personal opinion.
How many layoffs we've been having? Yes, we had a lot of layoffs in January, but frankly, it's a fraction of what we've seen at the end of 2022 and the beginning of 2023. Probably not an unemployment recession. JP Morgan says the biggest concerns we need to have going forward are negative jobs reports. Not really seeing that right now. Maybe negative retail spending, but thanks to buy now, pay later, we're not really seeing that right now. An inflation spike beyond January feels unlikely right now. To me, the bubble is much more clearly in particularly overvalued stocks. Costco, Wingstop, ARM. ARM, I think, has the greatest likelihood of popping in March, followed by multifamily real estate. And I think that's not so much of a devastating 08 style crash. It's more of an opportunity. Reason for that is the stability that single family gives you. Money that would go into investing in single starts going in multi, it balances out. And so when you take advantage of the higher cap rates you get in multi, you start getting some balancing effect. That's our opinion. That's our...
Okay, so that's pretty much covers Kevin's video here. I appreciate him putting out that video. I think it's an important subject. There's always going to be, the thing you guys got to understand, there's always going to be a million things they're saying, oh, it's going to crash, it's going to crash. There's a million videos out there and articles and things like that. Always predict and crash, and then eventually somebody's right, and they look like a genius because they called the crash, and they're calling the next 10 crashes that never come. It's just like the same story again and again and again, but just important to address those things when they happen out there. So, all right, guys, appreciate you joining me. I hope you enjoyed today's video. Thank you for being subscribed here. If you want to follow me on X or on Instagram, those will be pinned comment down there if you have either one of those services. I post quite a bit on both of them, okay? Much love and have a great day.